This episode is brought to you by Tools and Weapons, a podcast hosted by Microsoft Vice Chair and President Brad Smith. In it, global leaders discuss the promise and peril of the digital age, from environmental sustainability and cybersecurity to ethical AI. Guests like journalist Kara Swisher and Microsoft CEO Satya Nadella share lessons from their past to reframe some of society's toughest challenges and seek new solutions. Follow Tools and Weapons with Brad Smith on Spotify now.
If you are a lover of affirmations or you've just heard about how powerful they can be, then you are going to love the Daily Affirmations for Women podcast, created by the Women's Meditation Network and hosted by the amazing Jody Agard. Every morning, you'll receive an episode that is dedicated to one specific affirmation, so you can have the space to reflect on it and receive the power within it. Follow and start listening now to the Daily Affirmations for Women podcast on your favorite podcast player.
This is Optimal Finance Daily, episode 2440. What are your options for a 401k rollover to an IRA? By Jeff Rose of GoodFinancialSense.com. I'm your host and personal finance enthusiast, Diana Merriam. Thanks so much for joining once again here on Optimal Finance Daily. This is the show where I read to you from some of the best money and personal finance blogs on the web every single day of the week. So without further ado, let's get right to today's post as we optimize your life. What are your options for a 401k rollover to an IRA? By Jeff Rose of GoodFinancialSense.com. When you leave your job, either voluntary or not, you have to make an important decision regarding your 401k. Many aren't familiar with all of their options on what they can do with their 401k, but making the wrong choice could cost you. Most people are familiar with the 401k rollover concept, but still need some help through the process. Here are your options if you're faced with this decision. Cashing out is not the best option. What money you put in yourself, you can cash out and take with you. If your employer has a match, you may be subject to some sort of vesting schedule. Many people choose to cash out their 401ks. The most common reasoning I hear, especially for 401k plans that have matching, is that it's the company's money, not theirs. Wow, isn't that great reasoning? By taking the company's money, now that person is stuck with a 10% early withdrawal penalty plus ordinary income tax. Typically, when you cash directly from your 401k, they will hold 20% standard plus the 10% early withdrawal penalty. If you really need money, you could consider borrowing from your 401k. The problem here is that most companies want the loan balance paid off when you leave, whether you leave work by choice or not. Leave your 401k alone. You always have the option to just leave the money with your old plan. The money will remain invested, and the financial firm handling your 401k will keep mailing you quarterly statements telling you how it's doing. Any future growth will be tax deferred. But this passive choice comes with an opportunity cost. If you just leave the 401k assets in the plan, you're giving up control and flexibility. Your investment choices may be limited. The plan fees may be high, and you may not be able to quickly access your money or do what you want with it. If you have a trail of old 401ks left with a bunch of former employers, things can get really complicated when you retire, especially when you have to take required minimum distributions or RMDs. Leaving the money in the plan may not be the wisest choice. Transfer the 401k to a new employer. Most people have the option to transfer their old 401k into their new 401k with the new employer. In the past, this used to be more difficult, but with recent government regulation changes, it's much easier. While this could be a good decision, a lot depends on the new options that are in the new 401k. You could roll your 401k into an IRA. This is the choice that usually makes the most sense. You can move the money into an IRA through a rollover or a trustee-to-trustee transfer. Or you could direct the money into a so-called conduit IRA, a traditional IRA created to hold your 401k assets until you move the money into another qualified retirement plan. There's no tax penalty when you do an IRA rollover or trustee-to-trustee transfer. After you do it, you have total control of the money, continued tax-deferred growth, expanded investment choices, and possibly lower account management fees. Rolling over the money into a Roth IRA might be a great move, provided you can meet two conditions. First, your adjusted gross income has to be less than $100,000 for the year in which you make the rollover. Second, you'll have to pay taxes on the assets you convert. The upside is considerable. You get tax-free compounding, tax-free withdrawals if you're older than age 59 and a half and have owned your account for at least 5 years, and the potential to make contributions to your IRA after age 70 and a half without having to take RMDs. Contributions to a Roth IRA are not tax deductible, but there are fewer restrictions on withdrawals. In 2009, you can fund a Roth IRA with after-tax contributions to a 401k, 403b, or 457 retirement savings plan. You can take those contributions and convert them to a Roth IRA tax-free, provided your AGI is $100,000 or lower. There's no limit on the conversion amount. Incidentally, in 2010, anyone can convert a traditional IRA to a Roth IRA. The AGI restriction on such conversions disappears. What if you have to shiver through a 401k freeze? A freeze is when your employer reduces or suspends matching contributions to your retirement plan. FedEx, General Motors, and Motorola have all chosen to do this. The answer? Don't let up on your personal contributions. If you can manage it, adjust your 401k contribution to a level where you effectively replace what your employer contributed. Saving for retirement should remain one of your highest priorities. You just listened to the post titled, "What are your options for a 401k rollover to an IRA?" by Jeff Rose of GoodFinancialSense.com.
This episode is brought to you by Google. The Google Cybersecurity Certificate provides the necessary skills to begin a career in cybersecurity. Visit safety.google/cyberworkforce today.
This episode is brought to you by Tools and Weapons, a podcast hosted by Microsoft Vice Chair and President Brad Smith. In it, global leaders discuss the promise and peril of the digital age, from environmental sustainability and cybersecurity to ethical AI. Guests like journalist Kara Swisher and Microsoft CEO Satya Nadella share lessons from their past to reframe some of society's toughest challenges and seek new solutions. Follow Tools and Weapons with Brad Smith on Spotify now.
My 401k was with Fidelity through my employer, but when I left my job, I very easily rolled that over into a traditional IRA with Vanguard. I did this because IRAs offer more investment options than I had with my employer-sponsored 401k, and 401ks have more management and administration fees. Because both my traditional and Roth IRAs are with Vanguard, it also simplifies things for me when it comes to Roth conversions. 2022 was the lowest year of income I've ever had in my life. Seriously, it was lower than even when I was in college. So it was the perfect time to do a Roth conversion because I was in one of the lowest tax brackets. So I had the opportunity to pay just 12% of tax on that money. In addition to considering overall tax rates, I think it's very important to consider your income when determining if you will do a conversion in any year. The lower your income, the less likely you'll push yourself into the higher marginal tax brackets with your conversion. Self-employment causes my income to swing wildly, so it makes sense for me to do conversions when my income is low and hold off when my income causes me to get into the 24 to 32% brackets. Many people pursuing FIRE or financial independence retire early will wait until they quit their jobs entirely to start doing conversions. They'll plan it out to where they have a 5-year cash cushion or pull from their after-tax brokerage to fund their expenses to accommodate the 5-year waiting period. This allows them to take advantage of the lowest tax brackets for the conversions while also claiming enough income to qualify for ACA health insurance rather than Medicaid. But that brings us to the end of today's episode. Thanks so much for listening all the way through. Have a great rest of your day, and I'll catch you tomorrow where your optimal life awaits.